In previous videos, we've talked about discretionary earnings, what discretionary earnings is, how we come up with discretionary earnings, and how we price a business using the discretionary earnings that we came up with. There is another way that we price businesses as well, and that's pricing off of what is called adjusted EBITDA. And I want to talk to you about adjusted EBITDA today, what it is, and when you use adjusted EBITDA versus a discretionary earnings. So EBITDA stands for earnings before interest, tax, depreciation, and amortization. And then we're going to add the word adjusted in front of that because we're going to make other adjustments as well. EBITDA, adjusted EBITDA, is basically the same thing as discretionary earnings. We're doing all the same add backs that we're doing with discretionary earnings. However, with adjusted EBITDA, we are not adding back an owner's salary. And the reason we're not adding back an owner's salary when we're doing the adjusted EBITDA is it's usually or typically a larger business that is being sold. Who is the most likely buyer going to be for this business? Is it going to be an individual buyer that's going to be buying this business and getting an SBA loan? Or is it going to be a much larger business? If you're selling a business for $10, $15, $20 million or more, chances are it's going to be an industry type buyer. It's either going to be a private equity group, it could be a strategic buyer, but those type of buyers are not going to be an owner operator. And so we cannot add back the owner's salary because they're not going to be an owner operator. They're going to be putting a manager or somebody higher level in there to operate the business for them. Usually an investor of some sort, like private equity groups, like I said before. That is why we're not adding back the owner's salary for the EBITDA. So think on smaller businesses. Businesses are going to sell for a few $1 million, maybe $4 or $5 million and under. It's typically we're going to price it off of discretionary earnings. Much bigger businesses, we're going to be pricing it off of adjusted EBITDA. Sometimes when a business is around the $3, $4, $5 million mark, we're going to be using adjusted EBITDA and we're going to be using discretionary earnings because the buyers are going to be attracting. Some of them might be an individual buyer looking to acquire the business, and other ones will be people like private equity groups or groups like private equity groups acquiring the business. Now, the multiplier for discretionary earnings is usually lower than the multiplier for an adjusted EBITDA, but it kind of all works out at the end of the day because even though the adjusted EBITDA has a higher multiple, remember it's going to be a lower number than the discretionary earnings because we don't have that owner's salary. Instead of taking that owner's salary out, we're actually going to look at it and go, what is a reasonable or fair market salary for that investor to hire that person to run the business for them?